So, Al, as we get into this next segment and continuing this discussion, I should say, about how the financial markets really work, we're
Mhm.
talking about multiple markets because most people only know the stock market.
Right.
That's what they talk about on TV. That's where you see everything online about is just the stock market. Now, that's actually the smallest market that's out there. And we talked about liquidity and volatility earlier. You need volatility and liquidity in the financial markets. But a lot of people are stuck with this smallest market, that stock market.
Mhm.
Let's talk about some of those other markets that are out there, especially the markets that the institutions are using to create income.
Yeah.
Now, the reason they use those is there's perks to that. What are those perks?
Right. Well, you mentioned multiple assets, and there's also multiple directions that the smart money trades in, and you can use those multiple assets to trade in those multiple
That was a
directions.
tongue twister.
Yeah, but it came out okay, didn't
It
it?
did, yes.
Okay, I got a couple others that I won't go into here, but yeah, the smart money understands. First of all, the, let's talk about this for a minute. Why does the smart money know, or how do they know when to get into something and when to get out of it? Well, they do that because they put tons of money, millions, tens of millions of dollars into getting research and data that help them identify what the value of something is. So when they are entering a position, they know what the true value or what they feel the true value is. And then when it's overvalued, that's when they may be exiting a position. So they've done all that work because Wall Street has kind of convinced us that we need to do all the fundamental work, look at the balance sheets and all that to get to the point that the institutions already know and have already traded on.
That's an interesting comment there because that's the truth. Everybody thinks they need to do a bunch of research before they go and buy and sell a stock. The banks and institutions, as you said, spend millions and billions of dollars on that. But that's why it's important for us to identify where they're entering, and it's based off a price chart because the price chart does not lie.
A price chart cannot lie. What you see, when you see the price of something, basically everything that has an impact on that particular asset is built into the price at that point. That's not something that can be fudged. Opinions, on the other hand, opinions and comments that people make, those are just opinions and comments. There's not fact there, and unfortunately, that's how most people make their decisions. We feel that for our students, the best thing to do is just to make their investments based on fact, and the fact is that the big money moves the price of something, and the price is the most important thing. The right price also determines the quality of your profit potential and the quality of the protection that you want to have on every trade. Well, you mentioned multiple assets, so let's talk about those. Most people and most of you listening are familiar with the stock market and with mutual funds because that's really what Wall Street kind of pushes on us. One of the problems with just concentrating on those assets is that they're really it's a one directional kind of an investment. You're counting on the asset going up in value. If you buy a stock and the price of that stock doesn't go up, you're not going to realize a profit. So you want that to happen. You want to realize a profit, but what if it goes down? Is there a way to realize a profit there? There is. There are strategies that can be used to participate in down markets as well as up markets. But why are you put into strategies that only participate in one direction? It's because that's the easiest thing for Wall Street to do. Well, they're doing other things. And why do they do other things? Well, they do it because they get better value for their investment dollars. The other assets that we're talking about, and we go into these in our classes, would be the futures market, the foreign exchange market, the options market. Those markets all have leverage associated with them. So if you're looking at getting the greatest benefit out of every investment dollar, why not do it with leverage? In other words, every dollar that you are utilizing can control the multiple of it as far as the value of the investment that you have.
Yeah, and that's the key is to be more capital efficient. I mean, the futures market, that's your commodities, your gold, oil, silver. My favorite,
lean hogs.
Lean hogs. You can trade the S&P 500, the NASDAQ, the Dow. You have all these great opportunities, and as you always talk every single week, it helps you diversify properly as well.
Right.
And these are new to a lot of people. They're not different. We talk about the chart, and that does not lie. Fundamental information that creates opinions, right?
Mm-hmm.
Now, institutions, when they're buying and selling millions and billions of dollars per day, they leave a footprint. Explain what that kind of looks like, so our listeners and viewers on YouTube can kind of understand what the visual is and how how us as the retail investor can start to trade like them.
Yeah, it's sort of like looking at an X-ray and finding a broken bone. What we find on price charts is activity. We can identify in a price chart basically everything that you need to know. You actually, with a price chart, without even knowing what the asset is, you should be able to look at that chart. That's what we do for our students. Look at that chart and be able to determine whether it is an investment worth making. Is it? Are you trading against a novice? Are you trading against an institution? The institutions, they don't place, uh, uh, a couple $100,000 into a trade. They don't buy 50 shares or 100 shares of
Mm-mm.
a stock like Apple. They may buy a couple million shares. They buy in such large quantities that if they put all of the trade out at one time, the price is going to get away from what they feel is the real value of it. So they have to do their trades in increments, and almost always, and with a high degree of accuracy, or uh, the repeat or the repetition of what they do is over a period of time. So they'll put part of a trade in, maybe a little bit later they'll put another part of a trade in. Warren Buffett at one time, it took a position in IBM. It took him 7 to 8 months to get the full position filled. So
And when did he tell the public he was in that position?
well, that's a good point, because people like to invest in the same things that Warren Buffett invests in. So when he told them, this happened to be IBM stock, when he told them he had taken a 64 million share position in IBM, people ran out and started investing in IBM. It happened, he told you that after the full number of shares were filled. So the movement that he created every time he placed an incremental trade, that was over.
Mhm.
Then the public
People are
jumped in.
late to the party, essentially, and
Correct.
that's
And
what happens is people follow, these, things on TV and internet and hoping that, okay, they told me I'm in this, but they are already
they're
in it,
already in it.
which the big money, when they're telling people, they have already impacted that price with all that buying volume.
Right. And the key to what our students use, the key to having the opportunity to be successful is identifying actually beforehand when some of those incremental trades are going to be taking place, so you can have your trade already positioned. Tell your trading platform, okay, when the price gets to this point, get me in with X number of shares. If I'm wrong, here's my protection, get me out, so a small loss can never become a big loss. And then what if I'm right? What if I have a profit? Most people have no idea how to set a true target,
Yeah.
a realistic target,
Which is where to get out.
which is where to get out. So typically they will stay in too long and let some of that target or that profit be taken away from them, or they'll get out too soon and don't realize the full potential of the profit. So being able to identify a realistic profit level, a price level that you want to take your profit, that's important. And that's, again, based on where your entry price is first determined. But it's also based on when the institutions feel that that particular asset is overvalued and they're going to be selling. So just as we would have done on the buy side following institutions, we do the same thing on the sell side. So when they're getting out of a position, you want to get out. You don't want to have all of your profit taken away and possibly even part of your investment.
Yeah, and basically what Al is talking about is having a step-by-step, rules-based strategy, and that's for trading any assets in any market. When he's talking about these other assets, the futures and the forex market, he talked about the leverage earlier. I don't think we covered this, but they're 24-hour markets.
Yes, they are.
They're open around the clock. So think about this. If you're listening right now and you work during the day, you're kind of stuck to stock market hours, right? 8:30 our time till 3.
6.5 hours.
6.5 hours. Well, what if you had the opportunity to trade in the evening? Futures and forex are examples of 24-hour markets, which allows you to participate in the evening, and that's when people have the time to do things because it's tough to do it during the work hour. So, in these investing classes that you teach, Al, you talk more about the 24-hour market, why that's so great for traders and investors, but why the institutions particularly are using that to create income. But here's the interesting fact here. These techniques and strategies and assets are also available to us, the public. And that's why
Right.
it's great. The education is to understand what those are to make better investing decisions. Coming up next, I really want to dissect retirement techniques and strategies with 401ks and IRAs. We have a lot of, baby boomers that are planning to retire, but also people that need to really, continue to build for retirement. So let's talk about those strategies and techniques coming up next. This is Josh and Al, Investing with Confidence. We'll be right back.